Market volatility is one of those phrases everyone claims to understand, yet very few are truly prepared to live with. When prices swing violently, headlines turn dramatic, and portfolios flash red and green in rapid succession, the intellectual understanding of markets go up and down collides with a much deeper emotional reality. Volatility is not just a financial phenomenon, it is a psychological stress test. It exposes how investors think under pressure, what they believe about risk, and whether their strategy is built for calm reflection or emotional reaction. At its core, market volatility simply describes the speed and magnitude of price movements. It is not inherently good or bad. Volatility is the price of admission for participating in markets that grow over time. Without it, returns would be lower opportunities, rarer, and risk hidden rather than visible. Yet most investors experience volatility as danger because losses feel immediate while gains feel uncertain. This imbalance is hardwired into human behavior. The pain of losing money is felt more intensely than the pleasure of gaining the same amount, and markets exploit this asymmetry relentlessly. The first mistake many investors make is treating volatility as a signal rather than a condition. When markets fall sharply, the instinct is to assume that something must be fundamentally wrong, that danger has increased permanently. Sometimes this is true. Often it is not. Markets react not only to facts, but to expectations, narratives, and fear cascading through participants simultaneously. Volatility frequently reflects disagreement and uncertainty, not clarity. Understanding this distinction is critical because reacting to volatility as if it always represents new information leads to constant strategy changes and long-term underperformance. Staying calm during volatile periods begins long before volatility arrives. Calm is not a personality trait. It is a byproduct of preparation. Investors who know why they own an asset, what role it plays in the portfolio, and how much downside they have already accepted are far less likely to panic when prices move violently. Those who entered positions based on vague optimism or recent performance have nothing to anchor themselves to when conditions change. In that moment, fear fills the gap left by the absence of a clear plan. Another overlooked aspect of volatility is its relationship with time horizon. Short-term price movements feel overwhelming when viewed in isolation, but they often fade into insignificance when placed within a longer context. A 10% drawdown can feel catastrophic in a week and trivial over a decade. The problem is not volatility itself, but the mismatch between an investor's stated time horizon and their emotional time horizon. Saying this is a long-term investment means little if every short-term fluctuation is experienced as a personal threat. Volatility also exposes position sizing errors. Positions that are too large relative to capital or emotional tolerance turn normal market movements into unbearable stress. When fear becomes overwhelming, rational decision-making collapses. This is why intelligent investing is not only about choosing good assets, but about choosing sizes that allow those assets to be held through inevitable turbulence. A smaller position held through a full cycle often outperforms a larger position that is abandoned at the worst possible moment. One of the most dangerous behaviors during volatile markets is the search for certainty. Investors crave explanations, forecasts, and confident voices that promise clarity amid chaos. This is when noise flourishes. Media outlets amplify extreme opinions. Commentators speak with conviction precisely because no one can prove them wrong in the moment. Acting on this noise creates the illusion of control, but it rarely improves outcomes. Volatility punishes those who confuse activity with progress. Smart investing during volatile periods requires reframing the experience. Instead of asking, "What should I do right now?" a better question is, "What was I prepared to do when this inevitably happened. Volatility is not an unexpected event. It is a recurring feature of markets. Treating it as a surprise guarantees emotional decisions. Treating it as a scheduled test of discipline changes the response entirely. There is also an important asymmetry in how volatility affects different investors. Those with liquidity patience and emotional stability often benefit from volatile markets. Opportunities appear when forced sellers dominate. Prices detach from long-term value when fear overwhelms analysis. Conversely, investors who are over-leveraged, underprepared, or emotionally fragile are pushed into selling precisely when future returns improve. Volatility does not create these outcomes. It reveals them. Staying calm does not mean ignoring risk or pretending losses do not matter. It means distinguishing between temporary discomfort and permanent damage. Volatility hurts feelings. Bad decisions hurt capital. The discipline lies in absorbing the former to avoid the latter. This is not easy, and it is not natural. It is learned through structure repetition and an honest understanding of one's own limits. As we move deeper into this topic, the real challenge is not defining volatility, but developing practical behaviors that allow investors to think clearly when markets are loud, emotional, and unforgiving. Because knowing that volatility is normal does not automatically translate into acting wisely when it arrives. And bridging that gap between understanding and execution is exactly what we need to explore next, by examining how to translate calm understanding into smart action. When volatility strikes, because insight without execution collapses under pressure, the first practical behavior is narrowing the decision set. Volatile markets create the illusion that everything must be acted on immediately, when in reality most decisions should be deferred. Smart investors decide in advance which actions are allowed and which are forbidden during periods of stress. Selling long-term holdings out of fear is often on the forbidden list. Rebalancing within predefined ranges may be on the allowed list. This pre-commitment reduces cognitive load and prevents impulsive reactions. The second behavior is anchoring decisions to process rather than outcome. Volatility tempts investors to judge decisions by immediate results, but short-term outcomes during turbulent periods are random and misleading. A good decision can look terrible for months. A bad decision can feel brilliant for weeks. Staying calm means evaluating actions based on whether they followed a sound process, aligned with long-term goals, not whether they temporarily reduced discomfort. Process-based thinking is the antidote to emotional whiplash. Another critical practice is managing information intake. During volatile markets, more information does not mean better understanding. It often means more anxiety. Smart investors deliberately limit exposure to news commentary and constant price updates. They focus on sources that provide context rather than drama. This is not ignorance, it is hygiene. Mental clarity is a finite resource, and volatility consumes it quickly if left unchecked. Liquidity planning is also essential. Investors who know their near-term cash needs are far less likely to panic. When upcoming obligations are funded with safe assets, market fluctuations in long-term investments lose their power to threaten immediate security. This separation between short-term safety and long-term growth is one of the most effective ways to stay calm. Volatility is terrifying only when it endangers something that mustn't be risked. Rebalancing, when done thoughtfully, can turn volatility into an ally. As asset prices diverge, portfolios drift away from their intended risk profile. Periodic rebalancing forces investors to trim what has become expensive and add to what has become cheap without relying on forecasts. This disciplined action feels uncomfortable precisely because it runs against prevailing emotion, and that discomfort is often a signal that the process is working. It is also important to recognize when not to act. Many of the worst investment mistakes occur not because of incorrect analysis, but because of unnecessary action. Volatility creates a sense of urgency that rewards patience. Doing nothing when aligned with a sound plan is often the most intelligent response. This restraint is not passivity, it is controlled strength. Finally, staying calm requires perspective. Every volatile period feels unique while it is happening, yet history shows recurring patterns of fear, capitulation, and recovery. Remembering this does not eliminate pain, but it contextualizes it. Markets have always been volatile, and they have always moved forward through cycles of excess and correction. Investors who internalize this rhythm stop reacting to noise and start behaving with intention. In the end, investing smart during volatility is not about predicting the next move. It is about building systems that function when prediction fails. Calm is not the absence of emotion. It is the presence of structure strong enough to contain it. Those who invest with this mindset do not avoid volatility. They endure it. And in doing so, they position themselves to benefit from the very instability that drives others out of the market. If this discussion helped you think differently about volatility, consider subscribing to stay with these in-depth conversations that focus on behavior and discipline rather than forecasts, and leave a comment sharing what helps you stay calm when markets are turbulent, because the most valuable strategies are often personal, learned through experience rather than theory.